welcome to our webinar today, Business Cash Flow. This webinar is sponsored by the City of Westminster. We're very thankful for their partnership, and we're so glad you've all joined us. So before we dive into the material, I want to go over just a few things. So first, this webinar will be recorded, and I'll send you a follow-up email afterwards with a link to the recording, and also the presentation from Kevin will be included in that email. We also love these sessions to be interactive, and the goal is that we are all learning from each other, so please type in any questions throughout the presentation. We'll have some breaks for those and also a Q&A at the end. So you can submit a question in the gray questions tab on your GoToWebinar panel. It's on the right-hand side there for you. So some introductions now. I'm Hannah Curtis. I'm a coordinator with the North Metro Small Business Development Center, and joining us today as our presenter is Kevin McFarland. Kevin is part of the accounting faculty at Front Range Community College, Westminster campus. And Kevin has extensive experience working in corporate accounting and information systems and is an educational entrepreneur. So we're very excited to learn from Kevin today and hope to walk away with a better understanding of cash flow. So Kevin, I will turn it over to you now.
Okay. Thank you, Hannah. Hello, everyone. Let me share the presentation. It's a popular topic in the classroom. It's a popular topic amongst people who run and operate businesses for lots of reasons. And so we'll start with a catchy quote to kind of help put it in perspective. Never take your eyes off the cash flow. It's the lifeblood of the business. Richard Branson. The point here is that cash flow is the way bills get paid. A business isn't successful unless it's got positive cash flow. Cash flow is a symbol, if you will, or an example of the value of the business itself. And so one of the goals, obviously, of owners is to capture some of that cash flow for themselves, so that what we're trying to do is explain a little bit, because it is a concept. It's an accounting concept. It's a difficult one to show people sometimes how to calculate. You'll notice that there's no calculation in the presentation today, but the concepts behind it are what's important here. So first, I'd like to start with what is cash flow? Okay, cash flow is actual funds, money coming in or out of the business. Cash flow is a generic business term. You can have negative cash flow, which means cash is going out. Positive cash flow, cash is coming in. So increasing cash flow, there's, again, just some terminology. Increasing cash flow, increasing cash creates positive cash flow. Negative or decreasing cash is negative cash flow. Cash comes from three different areas of our business. I'll tend to explain it in terms of financial statements, but I expect that much of our interest is in how would you run the business day to day using this information. How could I tell? You know, you're not an accountant, so you're not going to pull out your calculator and do a cash flow calculation every day or anything like that. So how can you use cash flow to manage the business and know that you're doing okay? So cash flow comes from first, working capital. Working capital is nothing more than short-term assets like cash, accounts receivable, inventory, those kinds of assets that get used up within a business cycle, if you will, is one way of trying to explain it. Also, we reduce that amount of money by the short-term liabilities, things like accounts payable, money you owe to vendors, or accrued liabilities like amounts of, money that, for example, salaries or wages payable, other expenses, payroll taxes, taxes of any kind. So working capital is that net number of the assets minus liabilities. And what cash flow from these assets indicate is that you're running the business well, you're selling product, you're making an acceptable margin on the product in terms of being able to pay your expenses, and positive cash flow. We're going to call this operating cash flow. Indicates that you're doing a good job running the business. You've got demand. You're managing costs in an effective way. Okay. We also have, we look at our balance sheet, we look at what I call the long-term assets, those assets that last longer than accounts receivable and inventory. So things like equipment, cars, computers, any kind of, if you're a manufacturer, manufacturing equipment, those assets that last more than 1 year are long-term, and we can either have these long-term assets be a source or a use of cash flow. More on that in a bit. And last but not least, we can get cash or use cash related to our long-term liabilities and owner's equity or capital shareholders equity, lots of names depending upon what kinds of entities you're using, would determine what equity is called, but the point is the same. It's that credit side of the balance sheet, what you owe. So we can get cash flow from these items as well. More on that in just a few here. So as I've pointed out, positive cash flow is cash flow that is increasing. It's coming into the organization. Okay. Negative cash flow is a way of describing decreasing amounts of cash on hand. Okay. And that we call it a cash outflow, negative cash, lots of names, depends on who's doing the talking. Okay. So what cash flow is not? And so normally when I get to have this conversation with folks, everyone gets cash flow. We understand what money is. We understand when our checking account is ever increasing. That's a good thing. And now we have to talk about this other accounting concept called net income. So what cash flow is not, okay, there's a difference here in the difference between cash flow and net income. Cash flow, if you can have positive cash flow, you can have negative cash flow. Sometimes that's good, sometimes it's bad. My standard answer to anyone is it depends. We need to understand what the flow means. Net income is that number we get off of the income statement, that other financial statement that accountants prepare, that determine the difference between revenues and expenses. So this tells us you're selling the product for an adequate margin or a good margin. You're making your bill. It's got nothing to do with your bills really. It's you're meeting the cost of the product if you're selling something tangible. Make the cost of the service if it's something that's intangible. Net income measures how well the business is performing economically. If I were trying to explain to you what net income means, it really is whether you're performing an economically good thing by producing a profit. We're used to thinking, okay, if a business is profitable, that's a good thing. Well, that's one piece of the puzzle for sure, but net income is very different from cash flow. Okay, um, cash flow really winds up being management of business assets and liabilities in such a way as that they produce an adequate amount of cash and at the same time enable investment in products, processes, customers, whatever it is your business does. Um, it really is an investing process, and cash flow is part of that management. So net income tells us how well we're performing the function, okay? But cash flow is something different. Uh, any questions at this point, just to slow me down, because I tend to talk fast.
We don't have any questions in there right now. You've done a great job of explaining this very thoroughly, very well. So probably why we don't have questions as of yet. But for all of you listening, do feel free to type in those questions at any time.
Okay.
We'll take a couple other breaks as we go through, and we'll have some time at the end as well. So keep those
Yeah,
questions coming.
yeah, it just, thank you very much. So to my point about cash flow management, a business can be very, very profitable. Be a sensational business. When I say very profitable, what it means is sales are strong, revenue or sales is headed in the right direction. There are gross margin or gross profit, depends on what you're accustomed to saying, is again good for meeting the expenses of the business. If you want to think of it, the income is your tax return. Okay, how much money are you showing making? And you're really not making money at this point. You're making dollars and cents that we're keeping track of in the accounting records, but it isn't cash yet. Businesses can be very, very profitable, and it's not unusual for small to medium businesses to be relatively highly profitable businesses. In other words, they have margins north of 20%, or they've innovated a product or service that is really popular or hot and very popular with customers, and it might produce great margins and would produce net income, high levels of net income, but the company would be experiencing financial problems as they don't have the cash to pay its bills, its accounts payable, its liabilities when they come due. And it is not unusual for small to medium-sized businesses to have issues with uh, adequate amounts of capital, adequate amounts of cash. That's a big part of the Paycheck Protection Program logic during the pandemic here has been to try to provide the liquidity, to provide some cash into a system that just might be a business or economic system that might be a little clogged up at the moment with either accounts receivable and inventories. Because if you ask the question, how is it even possible for a business that is very profitable, I'm sorry, how can it not be paying its bills? Well, depending upon where in the product cycle, life cycle it is, depending again on, remember, the popularity or the hotness of its sales, if it's products and services, money may be put into other things besides leaving it as cash, meaning we'll invest in accounts receivable, which is we're making sales to customers on credit. Most sales in the business world certainly is done on credit. Okay, that credit takes cash to facilitate on the business owner's end, or the businesses doing the selling end of it. And the same thing with inventory. So we watch businesses that are growing, that have new ideas, that are in popular parts of their business cycle, will have tied up large amounts of capital, large amounts of cash in accounts receivable and inventory. And for the most part, your vendors will not accept accounts receivable or inventory in payment of their bills. They're looking for cash. Now, this is not an easy problem to solve, because one of the principal ways that businesses grow, provide, and generate opportunities is to create higher levels of inventory, carry higher levels of inventory, allow customers more credit than they might normally allow. The higher levels of credit allow customers to buy more. The inventories allow for a greater selection by customers. So in some businesses, it's part of, especially I worked in consumer durable products, and it's a very close relationship. In order to sell something, we have to carry lots of inventory, had to carry lots of inventory for customers to choose from. And at the same time, once they bought it, we had to provide them with credit terms, in other words, to go for a period of time before we received our cash. That's the good news. Okay, in this particular case, the income statement, the revenues minus expenses measure, would show nice increases. You would show profit because you've recorded the margin on those sales. The issue is that on a cash basis, you haven't received the cash yet. You've in fact invested more money than anything in trying to get to that level of business. And now what you've done is you found yourself looking for more capital, either through borrowing on the liability side, finding some equity on that liability side, or even possibly selling other assets that you may or may not need, or you need less than those increased sales. So this cycle, if you will, growth is a wonderful thing. We all would love to have double-digit growth every quarter, every year. However, the issue behind it is, for the small, and especially the smaller businesses, if they're producing products in particular, are confronted with cash requirements that really are needs for additional investment. Okay, so businesses need to manage accounts receivable. They need to acknowledge and understand that what extending credit to customers or extending more credit to customers will do to their cash flow. It delays it, right? That's why we're talking about it. If I go from giving customers 30-day terms to 60-day terms, or if I'm just selling them more product, I'm giving them bigger loans in the form of product. That's money I haven't got to pay employees, to buy materials and supplies, take compensation for myself, or purchase other assets. Okay, inventories, the same process here. Small business owners very often, without understanding the linkage between cash flow and inventory, try to keep as much inventory on hand as possible, again, in that consumer durable category, household goods. People go crazy when they think things are going to be good, when housing starts are offering opportunities to many small businesses. They start loading on the inventory, and then at some point the bill comes due, if you think about it, and that cash flow has to come from somewhere. So a very profitable business with lots of sales, may not be having the cash it needs to keep afloat or pay its bills. Okay, so generically, we talk about cash flow coming from three places. You look at a cash flow statement. That's for example, if you use QuickBooks software for accounting, or most accounting software will generate a cash flow statement. Um, we identify three sources of cash. We get cash flow from operations, and operations, we're talking about what is the normal undertaking of a business. What do they normally do? Do they sell hamburgers and hot dogs? Do they provide dance lessons? Do they sell airplanes? Whatever that normal cycle is, we're going to recognize, and I'm going to show you how to get a quick idea as to cash flow from these three areas. And so this is the operations where we see current assets minus current liabilities in accounting talk. We're looking for what has changed to my accounts receivable and inventories. Those are the two big ones, and we offset that a little bit with accounts payable. One thing about operating or working capital is that to some degree, when business grows, it is self-financing in the idea that as you buy more things from more vendors, your accounts payable tends to get larger in dollar volume as well. So those are loans that those vendors are providing you on a short-term basis. So part of your cash flow is coming from changes in accounts payable as they increase. Okay, so I think we all understand that service firms provide intangible revenues or sales. Usually they're not seeable or observable, or can't be held in your hand. Merchandise, on the other hand, are physical products, and those are tangible goods. And that's operations. So operating cash flow is normally we would like to see positive cash flow here. In other words, cash flow increasing. We use operating cash to meet up cash in other areas, meaning where do we get the money to buy new investments? Where do we get money to pay our debts? Where do we get the cash to provide returns to owners? We get it, generally speaking, from operating cash flow. It is possible to have negative operating cash flow. It's not a terrible sign unless it goes on as a trend for more than one or two periods. But negative cash flow would be an example where you're experiencing sales growth and you're making investments in accounts receivable and inventories, and that would force our calculation, if you will, to indicate that operating cash flow is negative. It was going down, okay, and or cash was going out. It's not a terrible thing as long as you understand what's happening. The issue is understanding that what caused it, and that it was intentful. I'd like to point out here what I talked about earlier as well, and this is what I call the small business paradox. And what happens is that it's not unusual for small to medium businesses have make great discoveries. They innovate. They have many new products. They have products that are popular with customers. They tend to have a very volatile business cycle. They grow very quickly. Um, the paradox is that very often it's these most successful small businesses that wind up selling out to larger organizations or not making it. Why? Because the cash flow management piece of this is a problem for them. Again, you can't make more sales if you don't have the money to invest in accounts receivable and inventory. And part of that you get from accounts payable. But if you don't have it, then the business kind of doesn't grow. And one of the things that's important for small businesses is that they grow. And so the paradox is that it's a fancy way of saying, okay, I've got a successful business, I got a great idea, and now I can't make it commercial because I don't have the capital. And so now it's part of the explanation, at least in the tech world, of why so many smaller tech firms wind up becoming part of the Microsofts and the Googles and the large players in that market, because it's the large players that wind up having the capital to take the great ideas and build them up. A small company with a new internet browser doesn't really usually have the resources to make it commercial, but very well might be able to leapfrog the products of some larger organizations. So that's the paradox. Okay. And so operations it provides the cash as ongoing. When I talk about investing activities, I'm really talking about what are we doing with our long-term assets? Are we buying more equipment? Are we selling equipment? And those activities, those assets produce cash or use cash, depending upon if I'm adding assets, if I'm growing, and I'm buying long-term assets, I'm buying more of them. And we're using up our cash in this way. It's not unusual at all to have negative investing activity cash. It's caused by the purchase of these assets. And but it's not a bad thing. It's just a matter of understanding what it is that we are expecting. Okay, we can also have positive cash from long-term assets by selling them. So let's say we have a building we no longer use or a machine we no longer use, car, things like that. If we sell them, those would be examples of positive cash flow for the organization, cash coming in. And what's the source of that cash? Well, it's in accounting terms, it's the investing activities. If you look at that cash flow statement, that's what it would show. But from the business end of things, you've given up an asset, and you have to decide whether or not that asset is something that you need. Any questions?
Yes, great. Thanks, Kevin. We do have some good questions that have come in.
Okay.
So we'll just go through a couple of these. Going back a little bit, Olga asked about the difference again between net income and margin.
Okay. So when I use the term, so margin is gross margin. So it's sales minus the cost of those sales. So if you're selling a product, a bicycle, for example, say the margin is the difference between the selling price of the bicycle and what did the bicycle cost me. So that's margin. Okay. And margin on products tend to be generic in terms of whether or not certain kinds of products tend to be in the same margin amount. And the way to describe it is, for example, the margin on groceries tends to be fairly low. The profit margin as a percentage of sales price would be high for like tech products like cell phones and things like that. So that's margin. Net income is you take the margin and you subtract out expenses like rent, payroll taxes, insurance, things like that, and that leaves you with your net income.
Great, thank you. I hope that clears that up a little bit. Olga also asks why inventory is not considered an expense.
Okay, so it's not considered an expense by those bean counting people, the accountants, because the inventory stays valuable. So as it sits on your shelf, that bicycle maintains its value until it becomes obsolete. Now, obsolete can mean lots of things depending upon the industry. There's nothing really high tech about a bicycle as an example, but for example, if the bicycle happened to be a color that was no longer popular, we might find that, or if the bicycle had stayed in inventory too long, that inventory would become obsolete. So inventory is cash going out when you buy it, okay, as you pay the bills, but it's not an expense yet on the income statement until you sell it to a customer.
Great, thank you. That's helpful. Just a couple more in here. Claire mentions that she uses QuickBooks for professional services, and she's asking if you can explain cash flow forecast.
Cash flow forecast. So what it's doing, okay, is QuickBooks will take, for example, things that it knows about. Okay, there's nothing magic here. If you've invoiced people and those invoices have a due date, okay, cash flow forecast will provide you the information of saying, okay, your cash flow as of, for example, in this case, maybe February 1st would be $1 million or $10,000, and it would be a product of it would go through and calculate the invoices that you've sold to customers, as well as any accounts payable vendor invoices that you have. Are they due? And that would be cash going out. And so the cash forecast feature of QuickBooks is trying to estimate how much cash you'd have on hand. We do it in the classroom. I have the students, for example, do the same logic, building a monthly cash forecast. And that's what QuickBooks is doing there. Pick a date, how much money do you have on hand? And it calculates amounts that you're going to get in the future. It assumes you're going to get them, and how much are you going to pay in the future?
Great, thank you. Seems like a helpful tool.
It is.
So last question for now, going back to the small business paradox that you mentioned, Ezekiel asks what you recommend as 3 things small businesses could do to avoid that paradox.
Okay, 3 things to do or things to do to avoid it. Well, the best, the premier way of avoiding it is if you developed a business plan and could accurately estimate the future. I don't know how well you would do that, but if you could build a business plan that estimates the popularity of a product and service and see when you see at which point effectively you run out of money, you you would do the cash forecast we just talked about, and when it turns negative, then you know you need to turn to a banker, turn to your credit card. Most small businesses are financed with owners' credit cards, as the truth has it, something like that. The other way is that you grow judiciously. You turn some stuff down. Not a pleasant thing to do, but we do talk about firing customers. Maybe some customers aren't good to have, and so be maybe selective about customers and accepting orders, or be careful about the credit terms offered. Many people will offer discounts, cash discounts, if your business is normally done in credit, and you have a cash crunch, offer 1 or 2% for the bill to be paid early by the customer, and that might be a way. Okay.
Great.
What else? You know, anytime you're successful, you're going to run up against it, and depending upon the source, and the problem is that small businesses aren't the preferred customers of most banks. So your banks don't turn out to be a great source of credit for small businesses.
Sure. Just a little plug. I know some of our business consultants with the SBDC get questions about how to help small businesses find access to other sources of funding and places that you know, might be a better avenue for them. So we would always recommend making an appointment with one of our consultants if that's the place that you find yourself. But thank you for those answers, Kevin. That was really helpful. And those are all the questions we have for now. So I'm sure we'll get some more as we go through the rest of the material.
Okay. All right. Very good. Sorry, I didn't mention Small Business Center. Okay. Here we go. So as I pointed out, the negative cash from investing in new assets is fairly normal. It's not a trigger for owner action to say, okay, wait a minute, I've got a problem here. And you don't really want to go into the practice of selling your long-term assets to generate cash. Why? Well, theoretically, anyway, you own those long-term assets as part of your process to produce the products and services that you sell. So by selling them, you have to be careful about your capacity to generate revenue. So that's why those assets exist. Okay. So the third sort area of cash flow is we call it the financing activities. It's the credit side of the balance sheet. It's long-term liabilities and owner's equity. Positive cash flow means that you're borrowing money or getting money from owners, and that's positive cash flow. An example of one business that was very successful in this mode was I think you've heard of it, Amazon. They went several years with negative operating cash flow. They were developing their processes, developing their products and services, so to speak, and so their cash flow came from borrowing money in decent sized amounts that kept them able to develop processes, find their business foothold. So it is a way of doing it. And so if you can find a source of capital or a source of financing that would allow you to keep the processes going, that's what financing does. Financing generally is usually negative. It's not unusual to be negative because if I pay a loan off, that's how I've I turn this kind of cash flow negative. And so when I get all said and done, the cash flow is the total of these three parts. So I add up the cash flow from operations, I add up the cash flow from the long-term assets / investing activities, and I take the cash flow, positive or negative, from the financing activities, and all that together will give me how much cash has changed during the period of time I have in consideration. And again, rather than I'm trying to focus not on showing you how to actually create a cash flow statement, because one, software and accountants can do that. What's important is for you to understand what causes positive and negative cash flow in these three areas. The purpose of the cash flow statement is to determine where the money comes from, where the money goes. Okay. Some of it good reasons, some of it bad reasons. And the purpose of the statement is to hone in and help solve business problems and correct them before it does any damage to your business. So the three parts that I'm talking about are the working capital, which are the short-term, or as we call them, current assets, and current minus current liabilities. The second piece is long-term assets, and the third is long-term liabilities. And so the easy method of tracking for the business person is that either if you've used a software that creates the cash flow statement for you, you can see in numbers and parentheses and negative symbols and that kind of thing. It'll show you your cash flow, break down your cash flow, tell you what caused the cash flow to change, or you can simply just pull out your balance sheet. You need two balance sheets, beginning and end of a period, whatever kind of period you want to talk about, a year, a quarter, a month, and you want to compare these categories from the beginning period to the ending period. In other words, how much working capital change from January 1st through December 31st last year. And just keep in mind that as assets increase, that's negative cash. As assets decrease, that's positive cash. Okay. So I've got it written down here. That's why I stopped. Okay, so assets increase or liabilities decrease is negative cash. Okay, and assets decreasing and liabilities increasing is positive cash. So from a cash flow point of view, it's better to use fewer assets, less assets. I joke in class and say, well, I'm not too good at paying people the money I owe them. And so, because I'm trying to increase my cash flow by increasing my accounts payable or accrued liabilities. I don't really suggest doing that in business because you probably wouldn't be allowed to borrow that way a second time if you purposefully didn't pay. But the impact of slowing down liabilities or slowing down assets would be to help cash flow. Increasing assets of any kind is going to make cash flow negative, as well as the decrease in liabilities. So as you pay debts off, as you buy more things of value, that cash flow is going to go negative. Okay, and again, QuickBooks is a good example, but almost all online accounting programs or cloud accounting programs that I've seen will generate a cash flow statement. It's one of the three important financial statements that we teach students about. But and all the program is doing is it's computing the change over a period of time. Questions? Anything I can help with?
Yes, we have one in here, and I don't want to go into all of the details to, protect privacy of businesses and things like that. But they're wondering maybe if you have any recommendation on how to know how much money to pull out for your own salary from your business. And then also, what type of organization should the cash be placed in, and how to know how much to maintain that long-term cash assets to pay for taxes and other expenses, those types of questions.
That's the tough question. The amount of cash to take out, I think that was the first part of the question, right? How much to take out of the business? Is one in which you're trying to leave enough cash in the business so that you have enough to work with. For businesses, cash is a tool or an asset and a tool, just like anything else, like equipment or any other asset. So the only reason a business has money is so that it can facilitate transactions. So you want to leave enough money on hand to be able to facilitate or to pay your transactions. So people do different things. My wife and I, as an example, ran a private elementary school for several years, and the kind of cash I would keep around is I always would add up what my disbursements, in other words, the payroll and all any expenses I would have, I would add them up for a month, and I would want to be sure that I ended the month with at least that. That was predicated on the idea that during the following month I would collect enough tuition and things like that to replenish the cash as I went along. And there were periods of time when actually I had more cash than that. So those would be good times to consider taking the cash out, or if you're looking to buy certain assets that you need, those are the periods of time. So you have to have a little bit of a cash forecast, if you will. And that's the hard part, of course, especially in these times. But it is possible to get it pretty close. It depends on your sense of conservatism as well. How many months, how many days, how much of that monthly disbursement do you really want? I grew to be comfortable with the 1 month one, because trying to keep much more actually posed a need for more capital that I didn't know where I was going to get it. So it's that kind of estimate. What was the other part of the question, Hannah?
What types of organizations would you recommend putting that cash into, if you have any recommendations?
Oh, the cash. Okay, so when I talk about cash, I'm not necessarily talking about dollar bills or actual currency. So usually cash is what we call a demand deposit, fancy name for a checking account. So you can use it's money that you don't really want to, or at least my risk profile is I would not want to take money that I need to run my business on a month-to-month basis and invest it in anything that would take time to recoup my principal. In other words, this is money I don't really want to lose anything. If I gain a little bit of interest or something, that would be okay. So would wind up with a bank's money market account, FDIC insured kind of thing. If you're more risk accepting, you could invest it in something else. Keep in mind that the investments like stocks or any funds like that have time horizons that are in terms of years and not days. This is money you're going to need very quickly. So I would keep it at hand.
Great. Thank you. That's very helpful. A couple other questions. Do you have a suggestion for a basic online accounting program other than QuickBooks? I know we've heard from several clients before that QuickBooks can seem pretty difficult for beginners, especially.
Okay. One program that seems to be I won't say easy, but it's more straightforward is Xero, Xero. QuickBooks was designed. It started off as software for accountants that decided to change their market focus to trying to put accountants out of business and train the small business user how to be accountants. Most small business people I've met aren't interested in that exchange. But the QuickBooks tends to be a little more complex for that. It also handles different businesses. Xero is a real straightforward program. And I haven't looked at Sage lately, but I think Sage 500 is popular amongst small business folks.
Great. Thank you. Those are some good ones to look into. So Claire asks, how do you account for interest in money market retainer accounts?
Oh, it's income. The interest is a kind of revenue, is a kind of sales.
Great.
So you would, as the bank or the institution pays or credits the account with interest, you would get a journal, you would get an entry. Almost all these cloud systems don't really operate in the traditional accounting way of debits and credits anymore. You download the transactions from the bank and you say, what do you do with this transaction? So, well, this $5.37 is interest revenue, and you can do it that way.
Great. Thank you. Olga's also asking if you have any recommendations for a template or app to help business owners plan a yearly budget.
I do. Let me find it. I'll give it to Hannah and you can pass it along. Is that something you want to do, or?
Yeah, we can include that in the follow-up email so that everyone can have access to that
Right.
recommendation. And I would also just mention again that we have business consultants that can help
Absolutely.
you walk through that with you as well.
Right. I mean, it depends on what kind of business to be clear. The more complex, and all I'm saying there is, if it's not a service business, if you're selling products, if you're it would pay to have a consultant help you from the business center, because someone just sitting down and trying it out probably would find it a frustrating experience trying to budget.
Great. Thank you. Well, and thank you so much, Kevin, for all this information today. I know it was really helpful. We so appreciate your time and your expertise.
Okay.
And a huge thank you to the City of Westminster for partnering with us and for sponsoring this webinar. They have some great resources for businesses in the Westminster area as well. So we'd encourage you to get in touch with them, look at their website. And we thank you all for joining us today. We will be sending out the follow-up email later today with the recording and with the slide deck, so you can review all of this material and have access to it. And Kevin, any last words for the viewers today?
It's cash flow is one of those areas that is exceptionally important. I take you back to Richard Branson at the beginning. It's the primary determinant of being able to maintain your business, and it doesn't have to be a complicated topic to understand.
Great, thank you. Well, thank you so much again, Kevin, and all of you for joining us, and we wish you a great rest of your day.
Okay, take care.